Trading stocks is an investment strategy that prioritizes short-term profits over long-term profits. It can be dangerous to enter without the appropriate knowledge. Trading stocks involves purchasing and selling company shares in an attempt to profit from price fluctuations. These equities' short-term price fluctuations are closely monitored by traders. They attempt to buy cheap and sell high. This short-term outlook distinguishes stock traders from traditional stock market investors, who focus on the long term. If you trade stocks accurately, you can make quick profits. However, it also entails the risk of significant losses. A company's fortunes can rise faster than the market, but they can fall just as rapidly. Trading isn't for the faint of heart, says Nathaniel Moore, a certified financial planner with Agape Planning Partners in Fresno, California. 1. If you're in need of funds, you shouldn't invest them. 2. Online brokerages have made it possible to trade stocks rapidly from your computer or smartphone if you have the capital and the desire to learn trading. 3. But before investing, you should ensure you understand how the stock market operates. 4. You should also educate yourself on the best stock trading applications and risk management. 5. There are two distinct categories of stock trading: day trading and active trading. 6. Active trading is when a trader executes 10 or more transactions per month. They frequently employ strategies that rely significantly on market timing. They attempt to profit from short-term events, at the company or in the market, in the short term. The practice of day trading involves purchasing and selling the same stock within a single trading day. Day traders have little interest in the interior workings of companies. They attempt to make a few bucks in the next few minutes, hours or days based on daily price swings. To accomplish long-term outperformance, the majority of investors are best served by keeping things simple and investing in a diversified portfolio of low-cost index funds. Consequently, the logistics of stock trading can be broken down into 6 steps. Open an investment account to engage in stock trading. A brokerage account must be funded. This account type is designed to store investments. In a matter of minutes, you can establish an account with an online broker if you do not already have one. However, opening an account does not imply that you are investing your money just yet. It simply provides the option to do so when you're ready. Establish a trading quota. Even if you are an expert stock trader, investing more than 10% of your portfolio in a single stock can be hazardous. Moore states, if all of your money is invested in a single stock, you could potentially lose half of it overnight. If you wish to invest, he suggests you begin by setting aside $200 per month. When you accumulate $1,000, you could invest $500. Think of the $500 that you are not investing as a parachute. You may not need it, but it's there just in case. Other do's and don'ts include only investing money that you can afford to lose. Do not use funds designated for immediate, must-pay expenses like a down payment or tuition. If you do not have a robust emergency fund and 10% to 15% of your income funneled into a retirement account, reduce that 10%. Learn to utilize market and limit orders after establishing your brokerage account and budget. You can trade stocks via the website or app of your online broker. You will be presented with various order type options. These dictate how your transaction will proceed. These are the two most prevalent varieties. Market order. Buys or sells a stock immediately at the highest price available. Limit order. Buys or sells a security only at or above a specified price. The limit price for a purchase order is the maximum price you are willing to pay. The order will only be executed if the price of the stock declines to or below that amount. Use a paper trading account for practice. Try investing in the market without investing any money in order to observe how it works, advises Moore. He says you can accomplish this by investing your time. Choose a stock and monitor its performance for 3 to 6 months. You can also learn about the market by using the paper trading instruments provided by a number of online stockbrokers. Virtual trading with stock market simulators allows customers to hone their trading skills and establish a track record before risking real money. Compare your returns to an appropriate benchmark. This is sound advice for all investors, not just the active ones. The ultimate objective of stock selection is to outperform a benchmark index. This could be the Standard & Poor's 500 index, often used as a substitute for the market. It could also be the Nasdaq Composite Index, for investors in technology equities. Alternatively, it could be one of the lesser indexes comprised of companies based on size, industry, and location. Measuring outcomes is crucial. If a serious investor is unable to outperform the benchmark, which is difficult for even professional investors, it makes sense to invest in a low-cost index mutual fund or exchange-traded fund, ETF. This is a collection of equities whose returns closely match one of the benchmark indexes. Maintain your perspective. Successful investing does not require identifying the next great breakout stock before the competition. By the time you hear that a particular stock is poised for a surge, thousands of professional traders already know this. The potential has probably already been factored into the stock price. It may be too late to make a profit, but that doesn't mean you can't join the festivities. Exceptional investments continue to generate returns for years. This is a compelling argument for viewing active investing as a hobby rather than a get-rich-quick scheme. How to mitigate stock market concerns regardless of where you lie on the spectrum between investor and trader. Taking things slowly, ignoring hot tips, and maintaining accurate records can help you trade safely. Reduce risk by constructing positions carefully. There is no requirement to dive headfirst into any position. Taking your time to purchase, via dollar cost averaging or purchasing in thirds, reduces your vulnerability to price fluctuations. Moore also suggests considering high dividend stocks, which distribute a portion of earnings to investors, and ETFs, which enable you to diversify your risk across multiple companies. People who participate in online stock picking forums and pay for advertisements promoting surefire investments are not your peers. Frequently, they are part of a pump and dump scheme. This is when unscrupulous individuals purchase large quantities of shares in a little-known, thinly traded company and promote it online. As unwitting investors purchase a large number of shares, driving the price up, the criminals pocket the profits. They sell their shares, bringing the stock back to earth. Do not assist them in lining their wallets. Maintain accurate records for the IRS without a tax-advantaged account, such as a 401k, Roth IRA, or traditional IRA. Taxes on gains and losses can become complex. The IRS applies different rules and tax rates and requires the filing of various forms for different types of traders. If you have sold stocks for a profit, you should set aside additional funds for a larger than usual tax bill. Another advantage of maintaining accurate records is the ability to use tax loss harvesting to offset other taxes with losing investments. To trade equities, a broker is required. However, do not fall victim for any broker. Choose the one whose terminology and tools best reflect your investing approach and experience. For time-sensitive transactions, active traders will prioritize low commissions and rapid order execution. New traders should seek out a broker who can instruct them on the necessary trading instruments. Some websites provide instructional articles, online tutorials, and in-person seminars. Consider the quality and availability of screening and stock analysis tools, mobile alerts, simple order entry, and customer service when evaluating stock trading applications. Even if there are more downs than ups, the time spent learning the basics of stock research and experiencing the ups and downs of stock trading is time well spent, so long as you enjoy the voyage and don't risk money you can't afford to lose. Don't forget to like, comment, share, and subscribe to this channel. Take care and remember that your money matters.